Another day, another scary headline. This one reads, real estate crash, steep property correction coming, strategist says. Wow. I mean, thanks for the prediction, guy. No one can predict what will happen. But let's talk about what he's talking about here, because maybe he has a little bit of a point. He does touch on some of the things that I've talked about in the past. So let's get right into this. So veteran strategist Chris Vermeulen says that we could be having a big correction, a large leg down in the real estate sector because of a few things that are pretty important. I do agree. And by the way, he is the chief market strategist of the Technical Traders. He pointed out that we have worrying flashing signals right now in the real estate sectors because, first of all, borrowing costs have gone up significantly. That basically means interest rates. So as interest rates have gone up, things get more expensive. That's how it goes. Obviously, I've talked about how the commercial sector is experiencing a lot of turmoil, a lot of problems coming up just around the corner, mostly because the people who purchased commercial real estate will not actually qualify for a refinance. And if you've never bought commercial property, let me tell you one big difference between residential property and commercial property, and that's the financing component. Wow, what was that? And every time I come to the parks, there's some sort of awesome nature event happening. I love it here. So the financing component of residential and commercial, the difference is that you can't get a 30-year fixed rate with no balloon payment on a commercial property, but you definitely can on a residential. In fact, that's the most common loan product. So when commercial properties were sold with such a low interest rate just recently in the last 3, 4, 5 years, they're going to have to refinance out, and most of the loans for commercial are about 5 years, 7 years, or sometimes 10-year balloon. So that refinance is going to happen at a higher interest rate, but the numbers also have to make sense, and the numbers are not making sense. By the way, I'm at the celery fields. I don't know if you can see, no, you can't really see it, but behind me here is the celery field, and it's basically like a little hill that you can go and walk up and down, and people run there and exercise and so on. But on this side of Palmer Boulevard in Sarasota, by the way, there is this lake, and it's really beautiful here. And there's a few of these gazebos out here and a whole path walking all the way around. So anyway, check it out if you're here in Sarasota. Now, Chris also mentions another point. He says construction starts for single and multifamily homes have plateaued. That means they haven't come down, they've just stopped going up, basically. And this plateau happened after last year having a pretty big decline. So what he's saying is that the bleeding has stopped. And all that means is that, you know, we're expecting to have less inventory hitting the market because we had a big drop from 2022 to 2023, and from 2023 to 2024, it's kind of stayed at that low level. So what does that mean for you as a home buyer or you as a home seller? Very simple. It means that the inventory is not going to be spiking up, and you're not going to be competing with a lot more properties. So that is not an indicator of prices that are going to have a big leg down, as he says, especially when we have the population growing and migrants coming in through the border and people immigrating to the United States. We are already short 4.5 million homes and dwellings. So I don't know if we're going to have a crash like this guy's saying, but there's a lot more points than just this inventory. Obviously, the one point he really does have that is a very good one is interest rates. And that's mostly for multifamily, large commercial spaces, and so on, because he's not saying that we're going to have a big crash in residential. He's saying we're going to have a big crash in real estate. So then he says that regarding this refinancing component being high cost, he says, to me, this is a sign that things are really breaking down and this is just a bounce. You know, I don't agree with you. I don't think we're having a bounce of anything. Oh, there's a gator. Damn, too bad I really can't zoom in here, but let's take a look. Oh, he just went down. He was right over there. Dang. I just really want to get a gator on video for you guys because, well, frankly, they're everywhere. Maybe next time. He then goes on to say that it's the last spot right now where you can squeeze a little bit of profit out of these buildings. He says materials and labor have gone up, and that is true. Over the last 5 years, I don't know what happened to labor and materials, but it has skyrocketed tremendously. And you know, surprisingly, after all the supply chain problems got fixed, prices haven't really come down that much. Now, I know lumber went up and down quite significantly, but you know, overall, labor hasn't gone down, and that's mostly due to inflation. And then the materials, they didn't come down that much. So we are still in an increased level of costs. So if you think about it, you know, how does that affect the future of building and the future costs of new buildings? Whether it's commercial or real estate, it really doesn't matter. It goes like this: if the expenses, the costs of the labor stay the same, which they probably will, because we're probably not going to have disinflation, and the materials cost stays the same, which is where it's at right now, which is at an elevated level, then whenever they build buildings this year, next year, whatever year, you know, even if we have a big spike of building, we're going to have higher costs. So just the baseline expense of building is higher than it was, but now we need to compound that with the high interest rates. And yeah, if we have interest rates go back down, let's just say to you know, 4% or something like that, then buying that finished product will be lower on a monthly basis, but the actual cost of that product, meaning the retail price, is not going to go down, right? It's going to be up. Now, they go on to say that, you know, the 30-year fixed rate is higher, and obviously we just talked about that, and that anyone who may need to refinance is going to be, you know, in a pickle, and they may not qualify for a refinance, they may not be able to refinance. But the reality of that is actually super low. Most people, if they didn't buy cash, then they bought, you know, with a 30-year fixed rate. Very few people go for ARMs, which are adjustable rate mortgages. Very few people go for balloon payments. Very few people go for, you know, payments that are just not affordable to them. It does happen though. I'm just saying it's really rare. So it's not like we're going to have a big drop in real estate prices and a crash from this small percentage of people that are in a pickle, and they're going to need to sell. And they're just going to sell either, you know, with a smaller profit at break even, or maybe even at a loss. That's not really going to impact the crash. Now, the next point they're making is actually pretty interesting, because it has to do with foreclosures. And they're saying that continued interest rate pressure could bring a wave of distress, says Vermeulen. So that is true, right? Because we just had data released by ATTOM, ATTOM. It's a good place to get a lot of data for real estate. And they said that commercial related real estate foreclosures jumped 117% year over year in just the first quarter. Now think about that. That basically means that from 2023 first quarter to 2024 first quarter, there are more than 2 times as many foreclosures happening. And this makes perfect sense, because the interest rate increase didn't start happening until mid-2022, right? So we didn't have too many people coming up on that renewal, on that balloon payment coming up at that point in time yet. And in the future, we will have, because, you know, we will have more people falling behind. You know, think about it like this. When did all those mortgages for commercial properties get taken out, whether it was a purchase or a refinance? Well, it happened during the lowest interest rate period. That was from, let's just say, third quarter 2020 to second quarter 2022. Literally everyone who financed or refinanced commercial property during that time is going to be coming up for renewal sometime soon. And by soon, I mean like within 3-4 years, right? And some of them, you know, 7 years. So there's still a little bit of time. But if our interest rates stay higher for longer, which is completely the message that the Fed is saying, right? Then people are not going to be able to afford to keep the commercial property. Whether it's hedge funds, whether it's individual investors, it doesn't matter. The rules are the same for refinancing for everybody. These are bank loans, and if you want the best rates, well, you have to qualify. It has to actually meet the underwriting guidelines when it comes to the repayment ability, okay? And that's going to be the problem when interest rates stay high. Now, the good news, if you could call it good news, he's predicting that the residential prices are not going to fall like they did in 2008, I should say. But he did say something that I really wasn't thinking would happen, but it could happen. And that is further price reductions and further panic could lead to like a big sell-off just from preemptive, people being scared, basically. The way he worded it is he said, further weakening could spark a panic sell-off among investors who have been putting cash to work in real estate companies and in things like real estate related ETFs. So, for REITs, for example. So that might mean that people want to pull money out of the REIT or their ETFs, or they might want to not renew, like if they join some sort of syndication, they might want to pull their money out at some sort of penalty. And eventually people get caught between a rock and a hard place just in general in life. That happens, and some people need to pull their money out. And in those scenarios, what can you do but take the money that you had in real estate, because that's a low performing asset at this point. And if interest rates stay high, it's going to be an even lower performing asset. You see, right now it might be performing just fine, mostly because they have a low interest rate locked in for another year or two or maybe 3. But eventually this is going to be a bad asset, and they're just going to want to pull their money out, and someone else is going to have to come and step in and take a lower return on their money invested. Or maybe they'll default and maybe the banks will take it back. That's where the foreclosures come in, and then there's going to be people losing a lot of money, but someone else picking it up at a more fair value adjusted price. And there are some places and some states and some cities where you can already find a bargain. And now this is not nationwide, because nationwide our prices appreciated 4% last year. I don't know this year yet. We're just in the end of June, so we don't have the numbers. But here are a few places where the housing market is starting to offer some value. They are in Louisiana, in Florida, and in Texas. These are the coldest regions, and I don't mean temperature cold, because we are not cold, but definitely the real estate market is kind of cool at this point, if not cold. These are basically places where we are seeing big rises of inventory. And just not even an hour south of me, I'm in Sarasota, Florida, and an hour south in Punta Gorda, it's like 45 minutes maybe, we had inventory go up by 200 to 300%, depending on what you're looking at. So the inventory levels are huge, but the prices haven't really dropped as much as I've expected them to just yet. And I do mean just yet, because if that inventory doesn't go away, if someone doesn't just scoop that stuff up and buy it, well, prices will follow. That's how it works. That's the law of supply and demand. Basic economic theory. Realtor.com is reporting that out of the coolest 20 metro areas, 15 of them are amongst Florida, Texas, and Louisiana. 3 great states, if you ask me. And if you want to know those 3 metro areas that are absolutely the coldest, where inventory is rising, where prices are falling, hear me out. We were looking at Lake Charles, Panama City, and McAllen, Edinburgh, Mission. These are the coldest areas according to Realtor.com, and they have tons of statistics. Realtor.com is like the official, website for finding real estate. Now, to add to that, let's look at Miami. They have actually had the biggest year-over-year price decrease. They're currently at 11.2%. That's a pretty big discount, and I do think it has a lot more to fall, my opinion. Okay, if interest rates stay where they're at, we're going to fall further, and that's just the reality. And the way I see it is like this: if you are renting and you're paying fair market value for rent, then buy. That's how I see it. I know I'm a realtor, and by the way, I am a realtor in Florida, so if you want to buy anything in Florida, reach out to me, please. All my contact info is below. 941-888-SOLD. That's my phone number. Anyway, if you're renting and you have fair market value rent, so let's just say you're paying $2,900 in Sarasota for a 3-bed, 2-bath with no pool, then I may say, hey, go try to buy a 2-bed, 2-bath, try to buy a 2-bedroom, 1-bath, try to get something that is more affordable, because you're going to be able to save a little bit of money and you're going to be able to pay down the mortgage. And then when time comes that interest rates do fall, whether it's 6 months from now, whether it's 1 year from now when we have a new president, or whether it's 5 years from now, it doesn't matter. At that point in time, refinance and get the payment to be much lower, because when interest rates fall, then you can expect the prices to go back up again. So you want to buy it when there's blood in the streets. And I wouldn't say we're like dripping blood everywhere just yet, but maybe we are. Maybe this is the worst it's going to be. I really don't know. I can't predict the future. I'm just here reporting on what's happening and giving you my opinion. I've been a licensed agent from 2004, and I've been investing in real estate since 2002. I've had rentals that entire time. I have managed rentals for others. I'm in the trenches. I am a full-time person. I see what's happening every single day, and I see what's happening with my clients and myself as an investor as well. I'm always looking at property. Every single week, I will see at least 24 properties. So I'm out there, I'm active, and I can tell you my opinion of what I'm seeing and how people are reacting. I'll tell you one thing, the more rural you get in Florida, the higher probability you'll have of getting a really low ball offer accepted, because there's not many buyers out there. And the more coastal you get and tourist area, like for example Sarasota or Miami, the lower probability that you'll have of getting a really low ball offer accepted. I recently had a client who probably was in, I don't know, I think 6 multiple offer scenarios, and they ended up finally purchasing a property. I'll tell you, those multiple offer scenarios are still happening, because when you find a deal, which is exactly what I love doing, I love finding deals on everything that I do, especially real estate, then there's going to be people who are just like me and just like you if you're a deal finder, and they're going to find a deal, they're going to offer low, and maybe someone else will too, and maybe it's a deal because it's already priced low. And sometimes you have to look at the properties that are on the market for 180 days, right? 150 days. Those offers you can really lowball. I have a client right now. When we listed originally, we were at $1.1 million. Listen, that was overpriced, and I knew it, he knew it, just giving it a shot, right? But as motivation went higher and higher, because he purchased a home and he didn't want to carry 2 mortgages. He doesn't want to carry 2 mortgages. We ended up going under contract. Now I can't reveal the price, but I can tell you our last listed price ended up being $780. So that seems like a big price reduction, but it's not, because we were overpriced. The real fair market value is somewhere between $775 and $800 for that property. But he was just testing the market, and you know what? In 6 months we had 4 showings. Now when we relisted it at a fair price, it went crazy. We had 4 showings on the first day, and we still didn't sell for over a month or go under contract. We ended up having to offer a buyer agent bonus. So the buyer's agent is getting a bonus, and this is all public information, so you can check it out. But he ended up bringing a buyer to us, whoever that guy was. He ended up bringing a buyer and cashing in on that incentive.